Very good morning, friends. So I hope you're all doing well. And as I requested, I hope your cumulative revision on Index 103 is going on. So we have made a very good background so far on Index 103. And I have basically started with the 7-step model just to remind you on the concept of acquisition accounting. So we've already covered a total of 3 steps with you, and my focus now today is going to be on the 4th step. But I think before we start off, a little warm-up exercise for the day before I take you on the step number 4. So we decided that when there is a transaction between unrelated parties, of course, there can be a transaction between related party also. If it doesn't meet the criteria of a common control transactions, you could fall under the purview of acquisition accounting. So it's not technically correct to say that only unrelated party transactions would enter the purview of acquisition accounting. Even related party transactions, provided they are not under the ambit of a common control, could come under the acquisition accounting. So let's make a little quick mind map. Just remember the key points, what we did in terms of the 7 steps, the 3 steps which we did. So I'm just going to make a quick mind map to give you a quick revision, a quick recap. So we decided that in terms of acquisition accounting, we've got a total of 7 steps which we are going to follow in a particular sequence. And in terms of the step number 1, I gave you that the first stage or the first step is identifying what is called the accounting acquirer. The focus is on the accounting acquirer. Now, when you focus in terms of identifying who is the accounting acquirer, I would just like to give you, some key 3 inputs which I gave you. When the consideration is primarily in cash, it doesn't make a difference whether a new company is created or not. So we can focus something like this, that if your purchase consideration is, let's say, primarily in cash, it doesn't make a difference whether a new company is created or the new company is not created. In this case, the legal acquirer as well as the accounting acquirer is always the same. Because in this particular case, your percentage share can never get diluted. So in this particular case, it's never a case of reverse acquisition. The legal and accounting acquirer will always be the same. But if your purchase consideration is, let's say, in terms of equity shares, if your purchase consideration is primarily in equity shares, then of course it makes a difference whether a new company is not created or a new company is created. Now, if you don't create a new company, your post percentages would decide whether it is a reverse acquisition or not. So we're not saying that it would be a reverse acquisition. It may be acquisition or it may be a reverse acquisition. So we'll just put it like this, that it may be. I'm putting it as that it may be a reverse acquisition. I'm putting it as RA. But in a situation when you are going to say that a new company is created, well, generally, it would always be a case of reverse acquisition. So in this particular case, when you create a new company, it's going to be generally always a case of a reverse acquisition. So this was the basic principles which we created in terms of step number 1. Their focus is in terms of the form of the consideration. And if it is cash, it doesn't make a difference whether the new company is created or not. And if it is shares, then yes, it makes a difference. Then I went ahead in terms of step number 2. And we said the focus in step number 2 is to get the date of acquisition. And when we decided that we're looking at a date of acquisition, we said the focus is the date of acquisition is the date when you get control. But there's another date which is called a closing date, when the consideration is paid. So your focus comes on the date of acquisition versus, you can say, the closing date. So when you're focusing in terms of the acquisition date, it is the date when you get a control. And when you look at a closing date, it is a date when the purchase consideration is discharged. Ideally speaking, the two dates are common. And in this particular case, we will always say the date of acquisition and the closing date is same, but there is a possibility that date of acquisition precedes the closing date. So we decided something great. So we said your date of acquisition is going to be dependent upon the fact. It is dependent upon the fact that if there is a binding or there is no binding agreement. So if there is no binding agreement, in this particular case, you would generally notice that your date of acquisition would be equal to the closing date itself. Because there is no binding agreement, it is difficult that a control precedes the date when the consideration is paid. But when there is a binding agreement, it is not necessary that you would reach a conclusion that the date of acquisition precedes. It depends upon the fact that is this binding agreement subject to approval or not. So you need to further see that is this binding agreement subject to approval. So we saw two cases as well. When you say it is subject to approval, or you say it is subject, no, sorry, if it is subject to approval, I would say, is that approval a mere formality? Or are you saying that the approval is substantive in nature? So we need to see that if the binding is subject to approval, your mind should immediately tell you, is that a mere formality or is it something which is substantive? Well, if it is a mere formality, then you can say the date of acquisition can precede. The date of acquisition can precede, in this case, the closing date. But in this particular case, the date of acquisition would always be equal to the closing date itself. It cannot precede. So this is what your mind should immediately tell you, when you're looking at a particular step. That was step 1 as well as step 2. Now, let's go to the mind map in terms of the step number 3. And in terms of step 3, I decided that we'll divide the journey in terms of 2 sub-steps. When you're going to look at the step number 3, that is the net asset list, it is better we divide this in terms of step number 3A and we divide this in terms of step number 3B. Now we said your first focus would be to consider if the tax rate is given in the question, and that would decide whether we are applying Ind AS 12 or not. A deferred tax asset or liability is to be considered or not. So in this particular case, everything depends upon is the tax rate given in the question. So if you say the tax rate is given in the question, then you are required to apply the principles of Ind AS 12 and create a deferred tax asset as well as a deferred tax liability on all those assets and liability where the carrying value, you can say the book value, differs the tax base. And in a situation where the tax rate is not given, then of course Ind AS 12 is not applicable. Then I am not required to calculate any deferred tax asset liability. And remember, of course, when you're going to consider this deferred tax asset and liability as well, this is also going to become a part of, it is going to become a part of the list of net assets out here as well. So I think it is necessary that you first identify the applications in terms of Ind AS 12 and get the DTA or the DTL, because that's going to be part of the acquisition entry. Get the focus clear there. Then in terms of the step number 3B, we decided that there are 3 blocks. We decided that there are a total of 3 blocks. So as a basic principle, we decided that we are going to consider the assets and liabilities in the balance sheet of the acquiree at a fair value. So all the assets and liability which are appearing in the balance sheet of the acquiree would be a part of the acquisition accounting at a fair value. So we saw one exception, that the assets and liabilities are appearing in the balance sheet, but they are not taken at a fair value. That's what we call a measurement exception. We said the assets and liabilities are not in the balance sheet of the acquiree, but they still appear at a fair value. And that's what we call the recognition exception. And we saw that there are assets and liability not in the balance sheet, and they are going to appear at other than the fair value. So the assets liability in the balance sheet appearing other than fair value, the assets liability not in the balance sheet appearing at a fair value, and the assets and liability which are not in the balance sheet but they are going to appear other than the fair value. So I give you a couple of exceptions out here, and to remind you, this particular exception was pertaining to contingent liability. And we saw a total of 3 exceptions in the first one and effectively 3 exceptions in the other one. When it came to the concept of assets and liability which are not there but taken at a fair value, so in this particular case, your indemnification assets is one, the crucial one I'm pointing out. So you consider the indemnification assets, and then we've also got employee benefits as well. So there could be indemnification assets, employee benefits. And when you're looking in terms, and the leases part also appears out here, which we have not discussed. And when it comes to assets and liabilities out here which are not taken at a fair value, non-current assets held for sale is going to be the focus point. So this is one of them, but of course there were others as well. Like for example, we had items like reacquired rights, though technically speaking, which category it belongs to, I'm not really concerned with that. So reacquired rights was out there. I think I'm mixing the items as well. So don't get worried on the block it belongs to. The main thing is that we need to consider the items. And of course, we also decided there could be intangible assets as well. So we need to consider the intangible assets as well, which may be internally generated, but they need to be represented as a part of the acquisition entry as well, if they are identifiable or they meet what is called the contractual legal right criteria. So this was a basic framework in terms of what we have discussed so far on the 3-step model. I thought I'll give you a quick recap in terms of things. Now we go to the next step, and that is step number 4. Now, the step number 4 is one of the very crucial steps indeed. You can get independent questions in the exams on step number 4 because it is such a huge step, and there are a couple of issues within the step number 4 where you could expect an independent question. So to make life simple, what I have done, I have again divided the step number 4 not in terms of 3 steps but in terms of 7 agenda. I would say 7 special issues in this case. So let me first give you the framework of the step number 4, then we'll start working on each of those 7 issues which are there within the step. So now my focus is in terms of the step number 4. Now, in terms of the step number 4, you can call it as consideration transferred. The technical word used in the standard is called consideration transferred, or in simple words, you can even call it as a purchase consideration. We're quite familiar, using the word purchase consideration since intermediate days. So even if you call it as a purchase consideration, it's fine. But technically, the standard use the word consideration transferred, which is given by the acquirer to the shareholders of the acquiree. Now, I would say when you're looking at the consideration transferred, in this particular case, there are 2 considerations which you will generally see in every question. The acquirer may pay to the shareholders of the acquiree. Mind the words as I use. The acquirer may pay to the shareholders of the acquiree company, number 1, cash. And number 2, he may issue shares in his own company. So what we'll do as a part of the consideration transferred, you will add the cash and you will add the fair value of shares issued. We will consider the fair value of the shares which are issued by the acquirer company. So this is a basic element in the purchase consideration, that you add up the cash which is given and you add up the fair value of the shares which is issued by the acquirer company. This is a basic component which you will confront. Now, apart from this, you're also going to consider a total of 7 issues as well. When you go to calculate a purchase consideration, I would say your focus is to be on the 7 agenda. So every time I'm going to calculate a purchase consideration, these 7 issues should confront into your mind. Now let's make a list of these 7 issues and we'll discuss them one by one. So as far as these 7 issues are concerned, the first one is what I call DC. For easy remembrance, I call it as a DC. I'm also going to map up, the inputs of 7 issues in your mind. So first one is called a DC. It's a deferred consideration. So the first issue is a DC that is called a deferred consideration. So let's not get worried on what is a DC. We'll make a walkthrough on that. At the moment, the first issue is a DC. That's called a deferred consideration. The second one is what I called CC. And the third one is also called CC. Now you would say CC, both CC. So one is contingent consideration in the capacity of shareholder. And one is a contingent consideration in the capacity of employee. Don't get worried on what it is. We'll see that. So this is called contingent consideration. It is called a contingent consideration. So both the CC are basically called contingent consideration, but this is contingent consideration in the capacity of shareholder. So it is paid in the capacity of the shareholder, or this is contingent consideration which is paid in the capacity of employee. So let's not get worried at this stage what is to be taken. Just look at the terminology. So I'm going to call this as CCS, contingent consideration, the capacity of shareholder. CCE, that's contingent consideration in the capacity of the employee. So in short, I'm going to call this as CCS, and this is CCE. So when you go to hear the term CCE, you'll understand employee capacity. CCS, you'll understand shareholders capacity. So let's make the life simple. DC, CCS, and CCE. This is like my block number 1. So this is the 3 inputs further. The fourth issue, what we're going to consider, is called PHI. The fourth issue is called a PHI. You've heard this earlier as well. That is called a previously held interest. We did this when we did the concentration test with you. So this PHI is called previously held interest. So PHI is called the previously held interest. That is the fourth input which I given you. Then the number 5 is going to be what we call SBP. I'm using short forms so that the mind gets very clear on these agenda. SBP is called the share-based payments. If you remember, I said, we're going to talk about the reacquired rights and the share-based payments later. So this SBP is what we call share-based payments. So SBP is supposed to be share-based payments in this case. And another one which we're going to consider is called TC. The other one is called a TC. So TC is supposed to be called as a transaction cost. TC is what we call a transaction cost. When I was looking at this standard for the first time in my life, I saw that, calculation of a purchase consideration is involving a couple of agendas which are very scattered at various places. I applied my mind and I started thinking that can we make a list of all the issues which are confronted in the calculation of the purchase consideration? And this is the byproduct. I created the 7 issue list. Trust me, this is going to easily make a walkthrough in terms of calculating a PC. So this is 1, 2, 3, 4, 5, 6, and we've got a 7th one as well. And the seventh one is called pre-existing relationship. This is not in a short form, but this is called a pre-existing relationship. So what is a pre-existing relationship? Don't get worried at this stage. These are the 7 special issues which we're going to confront. Trust me, this is a comprehensive list of all the issues which we are going to confront in the calculation of the PC. So the easy way to remember is DC, CCE, CCS, TC, PHI, SBP, and a pre-existing relationship. I'm sure at least, 5, 4 to 5 would have immediately inserted in your mind. When I say DC, deferred consideration, CC, contingent consideration, shareholder capacity, employee capacity, CCS, CCE, TC, all ending with C, DC, CC, TC. And then you got PHI, share-based payments, SBP, PHI, and a pre-existing relationship. Now, we need to work on each of these components one by one. So I'm going to explain the inputs in terms of each of these issues. We'll pick up examples wherever required in each of these elements, because you can get independent questions in some cases. I think the cases where you could get an independent questions could be something like a contingent consideration. This is one area. You can definitely get an independent question on a PHI as well as on a share-based payment. And there could be a question on a pre-existing relationship as well. So out of these 7 issues, you can see 5 issues are such good that you could get an independent question on only that particular issue. Let's begin the journey. So I'm now going to discuss these 7 issues with you. So what I'm going to do, I will discuss 3 issues together. I will discuss DC, CCS, and CCE together. I'm going to discuss 3 agendas together. 3 agendas together. So I'm going to discuss with you the concept of a DC. I'm going to discuss the contingent consideration shareholders capacity and the contingent consideration that is employee capacity. So let me discuss 3 issues in a single go. So, but why are you considering 3 issues in a single go? Because many times people get a confusion, and they're confused in terms of what is a DC and what is a CC. Now, please hear me carefully. Let me explain what is the difference between a DC and a CC. Now, there is a common element in terms of DC and a CC. A deferred consideration means something which will be paid later, not on the date of acquisition. A contingent consideration also means something which is going to be paid later, not on the date of acquisition. So the common element between a DC and a CC is, in terms of a deferred consideration, we are going to pay not acquisition date, later. In games of contingent consideration, we're not going to pay now, we're going to pay later. But in terms of DC, it's a confirmed payment. You are definitely going to pay in the future. There are no ifs and buts attached. But when it comes to a contingent consideration, it is dependent upon certain conditions. It is based on ifs and buts. So the first thing and the foremost thing what you need to remember is that if you ask me the similarity between a deferred consideration and a contingent consideration, I would say the similarity is that it is paid later. It is going to be paid not on the acquisition date, but it is going to be paid at a later date. But if you ask me that what is the difference, between the deferred consideration and the contingent consideration, I would say DC is going to be a confirmed payment. DC is going to be a confirmed payment. No ifs and buts. Definitely will be paid in the future. But contingent consideration depends upon ifs and buts. It depends upon ifs and buts. So there will be certain conditions which you are required to meet before this money would be paid. So the acquirer tells the acquiree, I will pay you after 2 years for sure. It is DC. The acquirer tells the acquiree, I will pay you this money after 2 years if the conditions are met. That is CC. So get it very clear. DC is a future payment without ifs and buts. CC is a future payment which is based on ifs and buts. Now, what are these ifs and buts? Now, when you look at the ifs and buts, it is also going to be important in terms of what these ifs and buts are. Now, hear me carefully, friends, because many people tend to get confused on this area. Let's consider there is a shareholder of the acquiree. Let's put it like this. So let's consider there is company A Limited, which is acquirer. And let's say there is a company B Limited, which is supposed to be the acquiree. And in this particular case, we've got the shareholders of B. We've got the shareholders of B, and some of the shareholders are also employees of B. The shareholders of these company B is also the employees of the company B. So there is a particular shareholder of company B who is also the employee of the company B. He's an employee cum shareholder of the company. So now what you need to watch out in this particular case is when A makes a payment to the shareholders of the company, we need to see that is this money paid in the capacity of the shareholder or is this money paid in the capacity of the employee? So A as an acquirer is telling the shareholders of the acquiring company that I will give you this payment. You need to evaluate this payment is given in what capacity. So are you giving him the money as an employee or are you giving him the money as a shareholder? How would I decide that? That would depend upon the ifs and buts. So for example, if the ifs and buts is supposed to be that you are telling him that you need to serve me, there is going to be a service condition. There is going to be a service condition. A tells the shareholders of B, I will pay you this consideration if you serve me for the next 2 years. So there is a service condition which is getting attached. If there is a service condition which is getting attached, it is paid in the capacity of employee, CCE. And if the condition is any other condition, not a service condition, but any other parameter, you tell the shareholders that, okay, if the turnover achieves this much, I give you this money. If the company's profit reaches this level, I give this money. So the conditions, ifs and buts is not asking him to serve the company, but any other factor. Then in this particular case, it is supposed to be in the shareholder's capacity. So which means it is going to be very important to evaluate that the consideration which is being paid in what capacity. And that depends upon those ifs and buts which are given in the question. If you're telling him that I will pay this money, you serve me for n number of years. There is a service condition attached. It is a capacity of the employee. But there is any other parameter, then in that particular case, it is supposed to be the capacity of the shareholder. So let's do one thing, friends. Let's make your life more simple. I am going to convert this entire discussions into a 3-step model so that you are able to understand what is a DC, a CCS, and a CCE. So let's do one thing. Let's, I think, consolidate this into a single thing. So what I'm going to do, I'll put the pen down the steps as well, but let me just consolidate the picture to you. I'm going to first of all see in the question that is the payment going to be made in the future? So your focus point in step number 1 is the payment going to be made in the future? If you say yes, it can be a DC or it can be a CC. So you go to step 2. Then in step number 2, you'll say, is the payment confirmed? If you say the payment is confirmed, it is a DC because it's a confirmed payment. So you will definitely give it. So it's going to be a DC. If you say, no, the payment is dependent upon ifs and buts, one thing decided, it is CC, then you go to the step number 3. In step number 3, you'll see what are the ifs and buts, what are the conditions attached. If the conditions attached is a service condition, it is CCE, and if it is any other condition, then it is CCS. Which means when you're looking at a contingent consideration, one thing is very clear. The possibility is that the shareholders of the equerry are also employees of the equerry. The same people who are the shareholders of the company are also employees of the company. So when A Limited is going to give them a consideration, it is important to evaluate, looking at the facts of the case, in what capacity the payment is given. Because if you're giving them a payment based on a shareholder's capacity, then it's a part of the PC. But if you're giving them a payment which is in the employee capacity, then it's not a part of PC. Then you are going to apply Ind AS 102 to the share-based payments. So in this particular case, moral of the story further, is the DC a part of PC? Sounds musical now. Is the DC a part of the PC? The answer is yes. And this will be taken at a fair value. Is the CC in the shareholder's capacity a part of the PC? Yes. And again taken at a fair value. Is the CCE a part of the PC? No. In this particular case, you are going to consider this payment, and depending if it is paid in cash, other relevant standards would apply. Other standards would apply, probably Ind AS 102. So why it is important to decide capacity of employee or shareholder? Because when it is shareholder's capacity, part of the PC. But if it is employee capacity, it's not to be taken as a part of the PC. I hope, friends, you got the picture clear. Did you get my inputs in terms of DC, CCE, CCS? We'll pen down the 3-step model. We'll do questions also on that area. No worries. That's wonderful indeed. So let me now take it further. I am just going to document a 3-step model, and then we'll do questions on this area. So let's give you a 3-step model. And this 3-step model, I am giving you combined on a DC, CCS, and a CCE. So we're doing a combined model in terms of deferred consideration, contingent consideration, shareholders' capacity, and contingent consideration, employee capacity. So we're going to go with the step number 1, and you're going to put a question. Is the payment going to be given? Is the payment going to be given in future? The focus is on the word future. So we're going to see that is the payment going to be given in the future? So the answer could be a yes or a no. So if you say yes, we will go to step number 2, because it can be DC, it can be CC. But if you say no, then I can say it's neither. It's neither a DC nor a CC. In this particular case, it's neither a deferred consideration nor a contingent consideration, because unless the payment is at a future date, it cannot meet the criteria. Then we go to the step number 2. And in step number 2, we'll say, is the payment based on any conditions? Is the payment based on any conditions? And circle the word any conditions. Let's put it as ifs and buts. So we need to see that is the payment based on any ifs and buts? Is it dependent upon any conditions or not? So in this particular case, the answer would be a yes or a no. So if you say no, it's not based on ifs and buts, then I can definitely say it is a deferred consideration. And if you say yes, I can definitely say it is contingent consideration, and I will go to the step number 3 as well. Because now we need to decide the capacity as well. So when you say that it is supposed to be a deferred consideration, we can say it's a part of PC at fair value. And what is a fair value? The fair value is the present value of future payment. So I'm going to calculate the fair value by considering the present value of the future payment. For this particular purpose, the examiner is going to give you a discounting rate as well. And if he gives you a discounting rate, then in that particular case, we'll take the present value of that payment in the future. Simple. And let's also take it further. In fact, something more is also coming to my mind as well at this stage. I don't know if I should complicate things at this stage or not. I think maybe a little, not an issue. I guess, friends, you must be quite aware of the fact that in terms of Ind AS, there is a golden rule. I always tell people that in terms of Ind AS, there is a golden rule. And what is the golden rule? If you consider the present value of something, you will see in the coming years, you're going to do unwinding of discount. I hope you remember that. This is a golden rule in terms of Indian accounting standard. You apply any standard for that matter. You would have seen that in terms of financial instruments as well. You would have seen that in terms of decommissioning liabilities in Ind AS 16. You would have seen that also in terms of Ind AS 19, employee benefits. You would have seen that in terms of Ind AS 37, when you create provisions as well. So in terms of Ind AS, when you consider the present value of a future payment, then subsequent years also leads to unwinding of discount. So I think it's worth making a mention at this particular stage out here that when you're going to consider the present value, we can also say it will lead to UOD. I'm putting it as unwinding of discount. It is going to lead to what we call UOD, unwinding of discount in future. So we will start unwinding and we will start recording a finance charge in the books of accounts at later years to come. Okay, so this is done. Now let's go to the step number 3 as well. So now let's see what is the input in terms of step number 3. Now, in terms of the step number 3, once you've said in step 2, it is a contingent consideration based on ifs and buts. Now ask yourself a question, what are these ifs and buts? So we need to see what are the conditions. So now you need to see what are the conditions, or I would say, what are those ifs and buts? Let's analyze what are these ifs and buts. And you would see the ifs and buts are of 2 types. Either there is a service condition, attached, or we can say it is any other condition. In this particular case. So you have to look at the facts of the case, read the inputs and see that what kind of condition is there. If it is a service condition, then it is contingent consideration E, employee capacity. It is not a part of PC. It is not a part of the purchase consideration. It is to be accounted. Using other relevant standard. So basically, it might be Ind AS 102, but I'm not putting it because it's not necessary that 102 will always apply. So this is going to be accounted using another relevant standard. Now, if you say in this particular case, it is any other condition, it is in the capacity of shareholder, CCS, contingent in the part of the shareholder's capacity, it is a part of purchase consideration. And this will be taken at a fair value. And now it's time to remind you, friends. Let's see if you remember this. Do you remember in financial instruments we decided that there is a financial liability which is called a contingent consideration in a business combination, and I told you I will also recall this when we come to 103. Do you remember? I gave you the financial liabilities segregated into various categories, and one of them was a case of a contingent consideration which is paid in a business combination. Do you remember, friends, on that area? We did this in financial instruments, classifications of financial liabilities. We did various categories of financial liability. One of the liability was CC in a business combination. Nobody said a yes on that. So this is the same contingent consideration which is taken at a fair value. So I will just like to make a mention that this contingent consideration which is taken at a fair value, can I say, maybe will be classified, it will be classified as a financial liability or equity instrument as per Ind AS 32. So you'll have to classify this as a financial liability, or you can say an equity instrument in terms of Ind AS 32. That part we'll see later. So because there is something which we need to see in good detail on this part as well. But remember, when it comes to a contingent consideration, it is to be classified for balance sheet purposes either as a financial liability or it is to be classified as an equity instrument. So we'll discuss this further. We'll do a little more detailed discussion. So see detailed discussions further. See details later. I'm going to discuss that today only, but I'll give you some more details on this area. So as of now, I've given you a 3-step model. I said the payment is made in the future. It is DC or CC. Is the payment based on ifs and buts? No, it is DC. If the payment is based on ifs and buts, it is CC. Go to step 3. What are the conditions attached? Service conditions. Then it is not a CC. It is CCE. And if it is other condition, it is CCS. CCE is not a part of PC, but CCS is a part of the PC at a fair value. And you also need to remember that this is to be presented in the balance sheet as a financial liability or equity instrument, depending on the parameters of Ind AS 32, which we will discuss shortly. Now, friends, let's do one thing. Let's apply these concepts to some questions in the study material. So before we discuss the other 4 issues with you, let's concentrate only on these 3 issues and let's have a look at some questions in the study mat. So I'm going to take you to the questions in the study material on this area. So there are a couple of questions which are given on this area. So let me just take you to this question on the area of this is reacquired rights. I don't need this. So we need, yes, this is the question. Great. So let's have a look at illustration number 25 of the study material. So let's have a look at illustration number 25 of the study material. This is a good question where we're going to apply our 3-step models out here. Let's have a look. So I am given, first of all, in this particular question, it says KKV acquires 100% interest in Viva, a company which is owned by a single shareholder who is also the KMP in the company. Did you notice something? He is very clearly telling you that the shareholder is also the KMP. That means he's also the employee of the company. So when payment will be given to him, we need to see in what capacity it is given. It says for a cash payment of $20 million and a contingent payment. He's already made it clear that it is CC. A contingent payment of $2 million. The terms of the agreement provide for a contingent payment 2 years after the acquisition if the following conditions are met. So one thing is very clear as you read the language: is the payment made in the future? Yes, after 2 years. Is the payment based on any ifs and buts? Yes, it is definitely contingent, though he's already told you that it is a contingent payment. Now, all you need to see is what are the conditions. It says the conditions are that the EBITDA margins of the company after 2 years reaches 21%. That's not a service condition. That's not a service condition. And then he also gives you another input as well. Let's have a look at the further input as well. Then he says the former shareholder continues to be employed with Viva for at least 2 years after the acquisition. Aha. There is a condition of employment which is attached to this payment. So which means I am telling the shareholder come employee, you work for me for the next 2 years, then I give you the payment. Is it CCS or is it CCE? Tell me. No part of the contingent consideration will be paid if the former shareholder does not complete 2 years of payment. So what do you say? And that's exactly correct. It is CCE. So in this particular case, determine the purchase consideration. I think we'll take only the 20 million which is paid in cash as a part of the PC. The contingent consideration is paid in the employee capacity, because if I apply my three-step model, is the payment in the future? Yes. Number two, are there any ifs and buts? Yes. And is the condition of employment attached? Yes. It is a CCE. Let's, I think, still read the answer. It says in the above scenario, the former shareholder is required to continue in employment and the contingent consideration is forfeited if the employment is terminated or he resigns. Accordingly, only 20 million is considered as a part of the consideration. The contingent consideration is accounted as an employee cost and will be accounted as per the other Ind AS. That's what I said. Other relevant standards would apply. Isn't that simple? Easy. Let's look at another illustration as well. Let's look at illustration number 26 as well. Now, in terms of illustration 26, it says ABC acquires all the shares of XYZ in a business combination. XYZ has got 3 shareholders with equal shareholdings, 2 of whom are also senior level employees of XYZ. Aha. So these 3 shareholders, out of them 2 are also employees of the company. So they are shareholders come employees of the acquiring company. So we need to see the payment is given in what capacity and would continue as an employee post acquisition. The employee shareholders, that is the 2 people, will receive 60 lakhs plus an additional payment of 150 to 200 lakhs based on a multiple of earnings over the next 2 years. The payment is made in the future. The non-employee shareholder is to receive 100 lakhs. So the 2 shareholders who are also employees are given 60 lakh plus an additional payment. 60 lakh is what you're paying them right now, and the additional payment is based on 2 years. And the non-employee is being given 100 lakh. The additional payment of each of the employees will be forfeited if they leave the employment at any time during 2 years following the acquisition. The salary received by them is considered reasonable approximation, reasonable remuneration for their services. How much is attributable to the post-business combination services? So let's put across the 3 questions to ourselves. Number 1, is the payment made in the future? Yes. Is the payment based on ifs and buts? Yes. Is the payment based on a service condition that you need to put in 2 years of service? Yes. CCE or CCS? What do you say? And that's rightly said. Again, it is supposed to be a contingent consideration in the employee's capacity because a service condition is attached. So I think I'm just going to go a little quick on the answer. It says arrangement in which contingent payments are not affected by employment termination may indicate that their payments in addition to the consideration. In accordance with the above facts, the additional consideration, which is that 150 to 200 lakhs, represents a compensation for post-business combination services, and that represents the payment which is forfeited and does not remain with them. So basically CCE, okay, I think I've just cut that part out. So basically we can say it is a contingent consideration in the nature of employee. So other relevant Indias would apply. This is not a part of the purchase consideration. I hope the two illustrations 25-26 gives you a good food of thought in terms of understanding whether it is a CCE or a CCS. Though I think in both the illustrations, the payment was very clear that it is a contingent consideration. Okay, that was great. I am also carrying a few questions which I picked up from the education material as well. Maybe I can just share some questions with you. Okay, this is the same kind of a question. Okay, let's, I think, do one thing. Let's add some more inputs to you. Now, having understood that as far as a deferred consideration is concerned, I want to now, give you a little more technical thoughts as well, because we are approaching all these steps from a larger question. Because when you're looking at the step number 4, the idea is also to look at a bigger question where you need to put entries in step number 7. Now, I know what I'm going to say right now is going to sound a bit technical, but I think we need to understand that bit very well. You can say payments in terms of DC or the payment in terms of CC could also lead to entries being done after acquisition date. Like, for example, I said, if it is a case of a DC, you will see entries being done for unwinding of discount post-business combination. So we need to be very careful that which component of the purchase consideration will lead to a subsequent accounting as well. Because if you look at the study material also, they made a discussions about some subsequent accounting of certain elements as well. So my journey doesn't end at this stage when I say that there is a deferred consideration, take a present value and include it in PC. What is going to happen later? So as we move ahead, we also need to be very clear that what happens to these elements on a subsequent basis. So before we discuss a DC, I've already said it leads to unwinding. I want to get into that CC a little more. I want to understand that if it is a CCS, then how do you decide that it is a financial liability or is it equity instrument as per Index 32, and what will be the subsequent remeasurements of those components? Watch this. My focus is now on a CCS. My focus is on a CCS. That if there is a contingent consideration which you zero down in the shareholder's capacity, my mind is now working on. So I would say whether it is FL or whether it is equity. So we need to basically decide that is it a financial liability or is it an equity instrument as per Ind AS 32. So I need to basically decide that is it a financial liability or equity instrument, because that will only decide the accounting for a future date. That's what it'll decide. So I would say that you should first of all evaluate that is the contingent consideration, what is the form of payment. So you need to see that what is the form of payment in this case, because Ind AS 32 focuses on the form of the payment. That's what we learned in terms of Ind AS 32. You need to focus on the form of payment. So if your form of payment is cash, or is the form of payment supposed to be equity shares? And you know this very well, that if the form of payment is supposed to be cash, it is undoubtedly a financial liability as per Ind AS 32. But if it is supposed to be equity shares, then it depends upon the number of shares. That also we've seen in terms of Ind AS 32. It depends upon the number of shares. If the number of shares is supposed to be variable, If the number of shares is supposed to be variable, it is a financial liability. And if the number of shares is predetermined, that is fixed, it is supposed to be an equity instrument. I hope you recall this part. This is basically what you're deciding as per Index 32. So Index 32 is deciding this part. So we are saying that in terms of Index 32, your contingent consideration, if the form of payment is cash FL, if it is shares, depends it is fixed or variable. Accordingly, it is FL or it is equity instrument. Now, remember the inputs what we did in financial instruments. If the contingent consideration is variable, if the contingent consideration is financial liability, so contingent consideration, which is a financial liability, is measured initially at fair value. It is measured initially at a fair value. And it is also measured subsequently also at FVTPL. Remember? It is also measured subsequently at FVTPL. So fair value changes is going to be captured in the profit and loss in the subsequent years as well. Because when you say that it's a contingent consideration, it is initially measured at a fair value and by virtue of Ind AS 109. This is by virtue of what we saw in AS 109. That it is going to be subsequently remeasured at a fair value, and in those cases, fair value changes will be captured in the P&L, gain or loss. And if it comes to a case of fixed number of shares, equity instruments, can I say in this particular case, the initial measurement, initially it will be taken at a fair value and there is no subsequent changes. There is no subsequent changes which are captured because equity instruments in this particular case are not remeasured. If the company is going to issue equity shares, the initial measurement will be at a fair value, but subsequently no fair value changes are to be captured. So this is another element which should be very clear at the back of your minds. So when it comes to a deferred consideration, in that particular case, it is undoubtedly a financial liability. And it is supposed to be unwinded in the future. If it is supposed to be a contingent consideration, it is again financial liability or equity instruments as the case may be. So let's do one thing. Let's mind the map. In terms of DC, in terms of CCE, in terms of CCS, what is the accounting initially and subsequently? And there is a wonderful question which awaits you on this area. So I am now going to make another interesting chart to you at this stage. So my focus now is in terms of these three elements. My focus is in terms of these three elements. That when I look at a question, there is a DC, there is a CCS, there is a CCE. How do you capture them initially? How do you capture them post-business combination? So I'm going to make an interesting chart out here. So I am working on the concept of the forms of purchase consideration. So let's take a column particulars and we're going to see what is going to happen on date of acquisition and what is going to happen on a post-business combination. Every component, the 7 list of issues which I gave you, you need to be very clear in terms of 7 issues. What is the accounting on acquisition date and what is the accounting in a post-business combination as well. For every issue, you need to be clear on the accounting acquisition date and the accounting which will happen on a post-business combination period. So when I look at the concept of a deferred consideration, so we can say on the date of acquisition, it's a part of PC at a fair value. It's a part of the PC at a fair value. So when you say that it is a part of the PC at a fair value, we say what is the fair value? It is supposed to be the present value. It is supposed to be the present value of the future payment. So whatever future payment is given to you, just take the present value and capture it as a part of the PC. What are we going to do, supposed to do at a later date? So what we're going to do in a post-business combination, we will do unwinding of discount. In the post-business combination period, we are going to do the unwinding of discount. You're going to pass the entry, finance charge gets a debit. You're going to put the entry, finance charge gets a debit, and the deferred consideration is going to get a credit. This is called unwinding. So we need to be clear on the picture that as on the date of acquisition, you capture the fair value as a part of the PC, and then year by year till it is paid, unwinding of discount happens. And that unwinding will lead to finance charge and the DC gets a credit. Next. I am looking at next that is supposed to be contingent consideration, shareholders capacity. Contingent consideration, which is in the shareholders capacity. This is again a part of purchase consideration, and this will again be taken at a fair value. This is not based on any present value concept. This is going to be given in the question. The examiner will clearly tell you that what is the fair value of this contingent consideration. So what will happen in the post-business combination? It depends upon the form of payment. The accounting subsequently will depend upon the form of payment in this case. So you will see that in terms of the form of payment, is this paid in cash? Or is this paid in variable equity shares? So you will see that is the payment made in cash or variable equity shares, or is the payment made in fixed equity shares? So you'll have to evaluate what is the form of this consideration. Is it cash or is it a variable equity shares or fixed shares? If this is the case, then it is supposed to be a financial liability which is remeasured at FPTPL. So the fair value changes will be captured in the P&L in this particular case. And if it is fixed number of equity shares, then it is supposed to be an equity instrument and no subsequent accounting is to be done. Then no subsequent accounting needs to be done in this case. I hope, friends, I am very clear with the picture. I hope you got the inputs very clear. That when it is a DC unwinding in post-business combination period, CCS depends upon the form of payment. If it is cash or variable shares, financial liability remeasured at a fair value through P&L. And if it is fixed number of shares, it is equity instruments, no subsequent remeasurements. And finally, we can also consider the third element as well, and that is a contingent consideration employee capacity. It is not a part of PC. It is not a part of the purchase consideration. And the post-business combination, other Ind AS would apply. So other Ind AS will apply. So most probably it would be Ind AS 102. So I'll just make a mention that generally Ind AS 102 would apply. So in this case, generally Ind AS 102 applies, but I've just made a mention that other in this case. Superb. Friends, I think now it's time to do a question on this area. So I guess wonderfully clear. That's great. So this takes care of my three issues. As I said, today is a day where I'm going to devote my time on step number 4 only. We are devoting time on the calculation of PC. I remember, intermediate stage amalgamation is 14. Your purchase consideration concept gets done in 15 to 20 minutes. Now in Ind AS 103, the purchase consideration has become a complicated affair, and it takes almost like 3 hours of journey to understand the concept of purchase consideration. Wow. Okay, that's great. Now let's do a question, friends, on this area. So there are some beautiful illustrations in the study material. pertaining to this area, which I will discuss with you. So let me come to the study material on this area. There is a wonderful question in the study material on this area. Let me just open it up. This is share-based payments. This is also share-based payments. Okay, so I think I am just going to bring you on this area. I've also added a few questions of my own. Yes, that is a beautiful question indeed. Let's, I think, have a look at this particular question. Okay, I've taken a small little question. This is in the education material. So let's have a look at this question. It's a beautiful question pertaining to the chart which I gave you. So the concepts would apply in this particular case. This is one of the questions which is given in the education material issued by the Accounting Standard Board ICAI on Indus 103. Many times people would say, sir, are we supposed to read the education material? No, 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 no. This is only for references where I thought that, some good questions are there. Let's pick them up and, let's do them in the classes. So let's read, how should a contingent consideration payable in relation to a business combination be accounted on initial recognition and on the subsequent measurement in the following cases? Can you see the focus is on the chart which I gave you? He's asking you what is the accounting initially and what is the accounting post-business combination subsequently. It says case number A, on 1st April 16, A acquires 100% interest in B. As per the terms of the agreement, the purchase consideration is payable in the following two tranches. You can say it's paid in two lots. There is an immediate issuance. Immediate issuance means right now, 10 lakh shares of A having a face value of 10. And a further issuance of 2 lakh shares after 1 year if the profits before interest and tax for the first year following the acquisition exceeds 1 crore. Now, I think I want to concentrate on this particular portion. When it says in this particular case that I will issue shares after 1 year if the PBIT exceeds a certain limit. Is the payment made in the future? Yes. Is the payment based on ifs and buts? Yes. Is the payment based on a factor other than a service condition? Yes. So is it a contingent consideration in the capacity of the shareholders? Yes. So we can easily decide that it's a future payment, 1. There is going to be a payment on ifs and buts, 2. And the payment is based on conditions other than a service, 3. It is CCS, part of the PC at a fair value. It says the fair value of the shares on the date of acquisition is 20 rupees. The company is issued a total of 10 lakh shares and the fair value of the share on the date of acquisition is 20. So we can take the fair value of the shares issued as a part of the PC. Further, the management estimated on the date of acquisition, the fair value of the contingent consideration is 25 lakhs. Now it says during the year ended 31st March 17, the PBIT of B exceeded 1 crore and as on March 17, the fair value of the share is 25 rupees per share. Now, we need to be very careful in terms of things. Now look at the answer very carefully to the part number A. So let's only first focus in terms of the part number A. In terms of part number A, if I'm calculating the purchase consideration, I would say number 1, there is an issue of 10 lakh shares with a fair value 20. So we can say the PC is going to comprise of share. So we are going to issue a total of 10 lakh shares at the rate of 20 fair value. So this is 200 lakhs. This is a part of the purchase consideration. Remember, the basic consideration is cash and the fair value of the shares issued. Then this is a contingent consideration, and see the contingent consideration has got a fair value 25 lakhs. So the purchase consideration is supposed to be 225 lakhs in this case. I also want to understand that this company is going to issue a total of 2 lakh shares. It very clearly says that we will issue 2 lakh shares, which means it is a fixed number of shares. If it is a fixed number of shares, it is supposed to be equity instrument. And if it is supposed to be equity instruments, no remeasurements are required at the end of the first year. Because this consideration is calculated on the date of acquisition 1st April 16, so we can definitely say in this particular case that the contingent consideration is in fixed number of shares. Since it is fixed number of shares, it is supposed to be equity instrument, which means no subsequent remeasurements required. No subsequent remeasurements are required in this particular case. Now, this was the part number A, where we've seen that we have taken the contingent consideration at a fair value, but no subsequent accounting because it is equity instrument. Let's see the part number B. It says, continuing with the pattern in A, the number of shares to be issued after 1 year is not fixed. If it is not fixed, it means it is variable in nature. And then it says, rather A agreed to issue variable number of shares having a fair value which is 40 lakhs after 1 year, and the PBIT in the first year following acquisition exceeds 1 crore. Now, let's see the answer to the part number B in this particular case. As far as the purchase consideration is concerned, of course, it remains at 225 lakhs. The purchase consideration for the part number B would remain 225 lakhs because you will take the fair value of the shares issued and you will also consider the cash component paid as well. Sorry, and the contingent consideration. But in this particular case, the contingent consideration is supposed to be paid in variable number of shares. If it is paid in variable number of shares, then it is supposed to be a financial liability. And if it is supposed to be a financial liability, in this particular case, we need to remeasure as well. And this will be remeasured at FPTPL, that is a fair value through profit and loss account. So he's very clearly said that the remeasured liability is 40 lakhs. So from 25 lakhs, it became 40 lakhs at the end of the year. There is a 15 lakh increase in the contingent consideration. So you're going to put an entry at the end of the first year. Let's put an entry at year end 1. So on 31st March 17, what I will do, put an entry, profit and loss debit. Contingent consideration gets a credit, 40 versus 25, 15 lakhs will be captured in the P&L. The fair value change. This is supposed to be, you can say, the fair value change in terms of the financial liability which is being captured. So I hope, friends, you are now able to see with this example that when a contingent consideration is paid in terms of fixed number of shares, it's an equity instrument, no remeasurements at balance sheet dates. But when the contingent consideration is in variable number of shares, there is a remeasurements which is at a fair value through P&L. Any fair value gains, any fair value losses are captured in the P&L at the end of each year. And that's what my chart is devoted upon. So your mind should be very clear. DC, a part of PC at a fair value, and thereafter UOD. CCS, a part of the PC at a fair value, subsequently depends if it is paid in cash, financial liability, remeasured, variable number of equity shares, financial liability, remeasured, fixed number of equity shares, equity instrument, not remeasured. And if it is a CCE, contingent consideration employee capacity, not a part of the PC, and therefore any other relevant standards would apply. So my 3 elements of discussions are done. I'm done with now DC completely, CCE and CCS completely. So far, so good. Let's get your comfort zone, friends, at this stage on a scale of 10. Because as I'm going to go ahead, things might become a little more complicated. Indeed, what is your comfort zone on a scale of 10 on the concept of DC, CCE, CCS? 10 out of 10, that's wonderful indeed. Superb. Great. Now let's take it further. I am now going to go a little further with you. So this is done. And I guess we can just add some more inputs out here. Maybe we can have a look at another small little question also. I put that question. Question number 6 is similar to the study material, but I think I'd like to add a question number 5 also, which I've taken additionally. So this question number 6 is same as study material. So this we've already done. This was the same question which I just did in terms of the payment ranging from 150 to 200 lakhs. Let's see the question number 5, testing time. Now I'm going to read the question. You're going to decide the fate of this particular input, testing time. So this is more like a small little test for you at this stage. It says ABC acquires PQR in September for cash. Additionally, ABC agrees to pay the selling shareholders an amount equal to 10% of the profits in excess of 10 crores generated over the next 2 years in cash at the end of 3 years. ABC determines the fair value of the contingent consideration liability as 1 crores at the date of acquisition. I think first of all, let's decide, is it DCE or is it CCE or is it CCS? Is the payment made in the future? Yes. Is the payment dependent upon ifs and buts? Yes. And is the payment in this particular case based on factors other than service? Yes. It is based on the profit exceeding 10 crores. So the conditions are not a service condition. So what is the nature? Can I say this is CCS? Wonderful indeed. And can you please tell me that this is going to be FL or equity?
FL.
Wonderful. And why is it FL?
It's a cash consideration to be paid.
Wonderful indeed. Since it is a cash component, it is a financial liability. So another question, but can we say, is it going to be remeasured on the balance sheet date?
Yes.
Yes, FPTPL would apply. Wonderful indeed. That's great. So on the date of acquisition, you'll take 1 crores as a part of the PC. Then he says, year after the acquisition, the company performed better than initially projected. Higher payment is now expected at the end. The fair value of this financial liability is already given you that it's a financial liability, 2.5 crores at the end of the year. So that means I will have to debit the profit and loss account, can I say by 1.5 crores? Because 1 crore you've already taken as a part of the PC. At the end of the first year, it became 2.5 crores. So 1.5 crores debited to P&L. Whether there should be any adjustments in acquisition accounting? If yes, by what amount? So 1.5 crores will be accounted at the end of the year. So now I think you've seen a question where there is a CC in cash, question 5, and there is a DC in terms of shares, that is question number 7. So when you're going to revise things, you can even map up the concept that questions where you've seen the CC in cash, question where you've seen the CC in equity shares, fixed and variable. Question 5, question 7. Super. Okay, so far so good. I guess now I want to add some more elements to the discussion. Let me just come back on the chart. I'm coming now back on the chart. We have covered the concept of DC, CC, and this. One element we can just quickly cover it out here itself. As far as a transaction cost is concerned, what is a transaction cost? A transaction cost would be something like a commission, a brokerage, which is paid to the middle agent to get the deal done. So you engage somebody and you pay a brokerage. So all that transaction cost is immediately expensed. The TC is never a part of the PC. It is immediately expensed. So this is outrightly not a part of PC. Not a part of purchase consideration. It is supposed to be immediately expensed. It is going to be immediately expensed in the profit and loss account itself. So TC is pretty simple and straight indeed. There is some question which is given in the study material on the concept of TC as well, though I think the concept is very simple that, if there is a TC. Now, why have they given a question with reference to a TC in the study mat? I'll tell you. If you acquire an asset, for example, I'm saying asset, not a business combination, but if it is an asset acquisition. So if you acquire, let's say, a land, or let's say if you acquire an intangible asset. So whether you acquire a tangible or an intangible asset, the transaction cost incurred is always capitalized as a part of the cost of the asset. If there is any commission or brokerage which I pay in order to acquire a tangible, intangible asset, that would be included as a part of the cost of the asset. But unlike in a business combination, the transaction cost is never included in the purchase consideration. It is supposed to be a revenue expenditure. It is taken in the P&L immediately. Let's have a look at this area as well. There is a question in the study material which is pertaining to this area. I guess, yes, that's the question. We can have a look at this particular question. So let's see question number 13. Question number 13 is given in the study material. So this answer is given in a lot of detail, but I guess I'm just going to read the quick inputs in this particular case. Let's have a look at question number 13 in this case. Now you'll see very interesting input which is given in this question. It's like, they're comparing a land acquired individually or a land acquired as a part of the business combination. How does that make a difference? Will a TC treatment be different or not? Let's have a read. Should a stamp duty paid on acquisition of land, this is transaction cost. Should a stamp duty paid on acquisition of land pursuant to a business combination be capitalized to the cost of the asset, or should it be treated as an acquisition related cost and accordingly expensed off? So we're looking at the cost incurred on the acquisition of land as a part of the business combination. So we are getting two things in mind. Standalone acquisition or part of the business combination, is the treatment going to be different? Yes. As per Ind AS 103, acquisition related cost incurred by the acquirer are not a part of the consideration transferred. So definitely not a part of PC. And then it says, para number 53, acquisition related costs are those costs, and I'm not reading that further. Let me just take it out here. The stamp duty payable for transfer of assets in connection with the business combination is an acquisition related cost. And therefore the stamp duty in this particular case is going to be immediately expensed. So it says in such cases, it's not a part of the fair value exchange between the buyer and the seller. So then he also adds up that it may be noted that accounting treatment for a stamp duty for a separate acquisition of an item of PPE differs under Ind AS 16. Unlike Ind AS 16, acquisition accounting as per 103 requires assets and liabilities to be measured at fair value. So while incurred in connection with the bank business combination, stamp duty does not increase economic benefits. But the nutshell is that if it is a part of a separate acquisition, it is added. So I think let me put it in nutshell out here. Let me just put the nutshell out here. So we can say if there is an acquisition related cost, if there is an acquisition related cost, whether it relates to a tangible item, that is a PPE, or it relates to an intangible item, intangible assets for that matter. So the summary which we are putting across is that if there is an acquisition related cost for a tangible or PPE, it depends. If it is a separate acquisition, if it is a separate acquisition of asset, or is it a business combination? So the moral of the story is that if it is a separate acquisition, it is added. Added means it is capitalized. It is added to PPE or to the intangible assets in this case. But if it is incurred in a business combination, it is expensed off. The treatment varies depending upon which standard triggers in a given situation. So this particular illustration is giving you this crux that if a company incurs an acquisition related cost on a particular asset, if it is a separate acquisition, Ind AS 16 or 38 applies. In this particular case, it is capitalized to the cost of the asset. But in terms of the Ind AS 103, it is expensed off, and there is a logic as well. In terms of Ind AS 16 and in terms of Ind AS 38, you record the asset initially at a historical cost. Since it is recorded at a historical cost, you can include the acquisition cost as a part of the initial recognition. But in terms of a business combination, the assets are recorded at a fair value. And in those particular cases, if you capitalize the transaction cost, you will overstate the assets more than the fair value. So since in this case the assets are recorded at a fair value, capitalization would not make sense. And in this case, since the acquisition is taken at a historical cost basis, capitalization would still make sense. So the same cost is being treated differently under the two different standards. A similar kind of illustration is also given in the study mat, which is on intangibles. That is 14. I think you can keep having a look at that later. So from 13, you can refer 14 as well. Okay, now let's come back on the agenda. So my 4 issues are done. I'm done with 4 issues. I am done with the inputs in terms of DC, CC, CC, as well as TC. Now we're left with PHI, share-based payments, and pre-existing relationship. Did I speak anything technical since morning? No, sir. Sir, you did. No, sir. Am I going to speak something technical now at this stage? Yes, sir. So these 3 agendas is what is going to now take a little higher. So I'm going to now discuss the concept of PHI. Let's give you a background on what is a PHI, because you can get independent questions on this area. There are questions in the study mat. There has been question which has already come in the exams on the concept of a previously held interest as well. Let's now understand PHI. So let me now take you to the concept of a PHI. That is my next area of discussion. PHI, that is called previously held interest. Now watch this carefully, because this is slightly technical in nature, but it's very, very interesting indeed. Slightly technical, but of course it's very, very interesting indeed. So we're going to have a look at the concept of a previously held interest in this particular case. Now the question what comes to the mind is that what is a PHI? Before a company, that is acquirer, gets a control over the acquiree, I'm saying before the acquirer gets a control over the acquiree, there is a possibility he already had a certain stake in the company. So maybe he had a percentage stake which was below 20. That means he was a passive investor. Or maybe he already had more than 20, then in that case he had a significant influence over the company. So PHI is also called sometimes, as a case of what we call step acquisition. It is also called a case of a step acquisition. That means we are saying that we have acquired the shares on a step-by-step basis. A further acquisitions is taking place. Now, there are 2 cases which are going at the back of my mind. I'm looking at a situation number 1 and I'm looking at a situation number 2. Now please hear this very carefully. This is going to be slightly technical, but you will easily understand, because this is going to involve a certain applications of standards. So let's have a look. So I'm looking at 2 situations. Situation number 1, let's say under the existing situation, the acquirer had less than 20% shares in the acquiree. Or the situation number 2 I'm looking at is under the existing situation, the acquirer had 20% or more, but you can say up to 50% stake in the company. So I'm looking at two possibilities, that the acquirer had below 20% stake, or he had 20 or more than 20 but up to 50% stake. Now let's get the position very clear. If the acquirer, let's say, had less than 20% stake in the company, you can say he was a passive investor. He was a passive investor in this particular case. And when he was a passive investor, he would have taken the measurement of this investment as per Ind AS 109. You heard me correct. If you remember, I had given you in financial instruments that if it is a related party, Ind AS 109 does not apply, 27 is applicable. And if it is a case of unrelated party investments, then Ind AS 109 definitely applies. Which means that if as an acquirer you had less than 20% stake in the company, you were a passive investor. And when you were a passive investor, you would have accounted things under 109. Now just try to recall. In terms of financial instruments, equity investments are measured at what value? Equity investments are measured at, by default, FPTPL. But since this could be a case of equity investments not held for trading, an option to consider FPTOCI would have also been there. Remember, equity investments in terms of 109 was FVTPL by default. But if they're not held for trading, then in those cases, FPTOCI option was also available. Which means that this company, the acquirer, must have accounted for these investments at FPTPL, or he might have accounted for these investments at FPTOCI, and equity investment is always no recycling. Equity investments in terms of 109 is always with a no recycling. So he might have accounted for these investments either at FPTPL, or he would have accounted them at FPTOCI NR. Now what is to be done? Watch this carefully. In this particular case, since it's a previously held investment, what I need to do, I need to basically remeasure at fair value. The previously held investments are to be remeasured at a fair value. So you already have these investments in the books of accounts. You need to remeasure these investments at a fair value on the date of acquisition. And this remeasurement will lead to a gain or will lead to a loss on remeasurement. And the gain or loss will enter the P&L or will enter the OCI, as the case may be. If your investment was accounted under FPTPL, the gain or loss will be taken in the P&L. If the investment was accounted under FPT OCI, the gain or loss will be taken in OCI. Don't worry, I'll map up the chart as well. But what is the basic input you need to do? You need to first of all understand that to this investment, he was accounting 109. And in terms of 109, he would have considered either FPTPL or FPT OCI. That instructions will be given in the question. If that investment was accounted under FPTPL, the fair value gain loss goes in the P&L. If that investment was accounted under FPTOCI, the gain or loss will be entered in the other comprehensive income. And if the investment was accounted under OCI, the accumulated balance in OCI, that is in tab 3 of SOKI, will be transferred to the retained earnings as well. Sir, आपको दया नहीं आती? सुबह से आप हमको एक एक करके बोलते जा रहे हो, ऐसा करो वैसा करो. But I know the things are difficult, but they're interesting at the same time. So there are a lot of things, I always tell people that in terms of financial reporting, the only challenge is numerous number of information. Huge lot of information in life. That's the only agenda. So you just need to remember and you need to make your mind maps. I keep doing those mind maps to you in the class. When you are done with the particular standard, make your own mind maps as well. Because those crucial small little points is something, which you need to keep a track. And that will be helpful only when you map them up in a mind map. You know that, okay, in this agenda, this is to be catered to, this is to be thought of. So, moral of the story, if you've got existing investments, those existing investments accounted under FPTPL, remeasure gain loss in P&L. If it is FPT OCI, remeasure gain loss in OCI. And if it is OCI, accumulated balance in tab 3 will also be taken to tab 2 retained earnings. I'll document that, not an issue. Now let's come to the second situation as well. In terms of the second situation, when the existing investments was 20% or more, but up to 50%, that means as an investor, you had a significant influence. So in this particular case, we can say that you had a significant influence. If you had a significant influence in this particular case, the investee company would have been your associate. And if it was your associate company, you would have applied Ind AS 28, which you're yet to study. Because in consolidation, you're going to see that if you've got a significant influence over an investee company, that company becomes your associate company, and you would have applied Ind AS 28. And in terms of Ind AS 28, you would have applied an equity method of accounting. You would have applied an equity method of accounting prescribed under Ind AS 28. And here again, what you'll have to do at this particular stage, you will have to again remeasure the investments on the date of acquisition. This will also be remeasured at fair value on the date of acquisition, and the gain or loss which is arising. And the gain or loss which will arise in this particular case is going to be taken in the profit and loss account. This is going to be taken in the P&L. So, moral of the story, the gain or loss in this case, goes in P&L or OCI. The gain or loss in this case always goes into the P&L. Sir, are these the only two cases of step acquisitions? Yes. In terms of Ind AS 103, yes. Because the two-step acquisition is that either it was a passive investment converts to control, or it is a case of a significant influence and converts to a control. So let's make a small little chart before we do a questions on this area. So at least we're clear in terms of what we were doing and what we are supposed to do. And then we'll see practical questions also on that area. There is something more, which is coming to mind in terms of equity investments. Not at this stage. We'll not discuss at this stage. So let's now get the inputs very clear. So I am working on a PHI that is also called a step acquisition. So let's get the mapping very clear. What is the kind of accounting we are going to do when it is a case of a PHI? So let's have a look in terms of the PHI. So I'm going to make two permutation combinations in this case. So we're looking at two permutations, combinations. At this stage, I am looking at situation, and I am looking at the accounting based on the two situations. So let's summarize the inputs to you. So we can say the situation number one could be that you are converting from a passive investor. You are converting from a passive investor to a case of control. As a passive investor, you were applying Ind AS 109. And now since you have come to a control and you're applying Ind AS 103. So you're applying Ind AS 103. So what is the accounting to be done? So we can say earlier, you were considering the investments either at FPTPL or you were considering the investments as per FPT OCI NR. So based on Ind AS 109, you would have accounted the investment at FPTPL or you would have accounted under FPT OCI NR. So if you're accounted under FPTPL, what we'll do, we'll remeasure. We will remeasure at fair value on date of acquisition. We will remeasure at fair value on date of acquisitions. In this case, the gain or the loss will enter the profit and loss account. Simple. In this particular case, the gain or loss, in this particular case, the gain or loss is going to be transferred in the other comprehensive income. Simple. So it all depends upon where you were. If you were under FPTPL, the gain loss in the P&L. If it was FPT OCI, the gain loss in the OCI. And in this case, you need to do another thing as well. Accumulated balance in SOKI, accumulated balance in SOKI in tab 3. Because if you are accounting under FPT OCI, you would have accumulated the balances in tab 3 SOKI as well. So the accumulated balance in SOKI tab 3 is going to be transferred to tab 2, and that is retained earnings. Since the investment is now being shifted to another standard, this is what more you need to do. So the amount of gain loss in this case in the P&L, the amount of gain loss in this case OCI, and another additional input is accumulated balance in tab 3 shifted to the tab number 2 as well. Let's look at the second situation now. The second situation is that you were supposed to be having a significant influence. You were having a significant influence, which means you were applying Ind AS 28 in this case because it became an associate. And now you are switching over to the concept of control, in which case again you're coming to Ind AS 103. So conversion from a significant influence to a case of a control. So in this case, what were you doing earlier? Earlier, we were accounting under what is technically called equity method of accounting. Let's not consider what is equity method at this stage that we'll see in Ind AS 28. We just need to consider that we were applying the concept of equity method. Am I supposed to again remeasure the investments at fair value? Yes. You will again remeasure at fair value on date of acquisition. We will remeasure the investments at a fair value again on the date of acquisition. And the remeasurement will again result in a gain or a loss. And in this case, the life is simple. The gain or loss is going to be taken in the profit and loss section. So moral of the story is, I think, simple to put it across in this chart. If you were a passive investor at PTPL, gain loss in PL. If you were a passive investor, APT OCI, gain loss in OCI. If you were a significant influence, gain loss in P&L. And in the second case, when it is OCI, accumulated OCI balances also transferred to the retained earnings in tab number 2. I hope the structure is clear, right? So far, so good. I hope the structure is clear. I think it's time now to give you some break as well. I'm sure you'll need one. We'll do some practical illustrations on these cases. We'll do questions on both the cases of a passive to control and significant influence to control, but I think after the break, because there is something more which is to be given on the second case. Because during the course of the equity method also, something very interesting comes in, which is to be considered at the switchover. But that I'll tell you after the break. So let's take a break, friends, and let's relax the minds at this stage. So let's give you a 10-12 minutes break at this stage. I'll join you after the break. Please enjoy your minds. Okay, thank you. So I hope you had a relaxation of mind. So we were talking in terms of PHI, that is a previously held interest, also called as a step acquisition. And I've given you conceptually what are the two situations we can confront. So I think there is one more thing which I need to tell you about conversion from a significant influence to control, but that we'll see in a question later. Let's first look at a question on situation one. So there is a question in the study material which is dealing with the first case. So let me just take you to the question in the study material on the case number one. Okay, this is the question. This is in the test your knowledge. And this question is question number 5, which is given in the test your knowledge section at the end of the chapter. So let me just read the inputs to you and we'll identify the accounting. It says on 1st April X1, Company A acquired a 5% of the equity share capital of Company B for 1 lakh. Now, the moment when you acquire a 5% stake in the company, it definitely indicates that you are a passive investor because you've acquired below 20% stake and Ind AS 109 should apply. A accounts for the investment at a fair value through OCI under Ind AS 109 financial instruments. He's very clearly given you that this investment is accounted at FPT OCI, which is with a no recycling. So I think now my mind is very clear that this is a case of conversion passive into control. Then he says on 31st March X2, A carried the investment in B at a fair value and it reported an unrealized gain of 5,000 in other comprehensive income, which is presented as a separate component of equity. So this is presented as a part of the tab 3 in terms of SOKI. When it says separate component of equity, that is tab number 3 of SOKI. Then he says on 1st April X2, A obtains a control. So you're converting from a passive to a control by acquiring the remaining 95% B. Comment upon the treatment to be done based on the facts which are given in the question. So I guess the details are very clear that in this particular case, it's a conversion of a passive investment into a control situation. So let's see what is to be done. So we know from the conceptual knowledge we acquired that the company was a passive investor. And from a passive investor, they are converting into a controlled situation. And I guess if I apply these standards, we were covered under Ind AS 109. And we are now going to switch over to the concept of Ind AS 103 and of course Ind AS 110 as well because of the consolidation. So in this particular case, this investment was accounted at FPT OCI. That is no recycling. So what is the value at which investment was acquired was 1 lakh and there is an unrealized gain of 5,000 in OCI. So we can say in this particular case, the investment is standing at a book value, which is 1,05,000. This is standing at 1,05,000 in the books of accounts. And this is also equal to the fair value also, which is on 31st March X2. Because this investment is taken at a fair value. So on March X2, it is standing at a book value of 1,05,000, which is also the fair value. Now, once you switch over to 103, you need to record at fair value. You need to record at a fair value, and it is already at fair value. It is already at a fair value because this transaction happened on the next day morning. That is on 1st April X2. So it is already at a fair value. So there is no fair value change on the date of acquisition. I said there is no fair value change on the date of acquisition because it is already at a fair value and it is going to be shifted directly. But the only additional thing which you are required to do, can I say the only additional thing which I'm required to do, the accumulated balance in SOKI. The accumulated balance which is in tab 3, this is going to be transferred to retained earnings, that is in tab number 2. So the company will just have to transfer this balance of 5,000. So this accumulated balance in tab 3, which is 5,000 rupee, is going to be transferred in the tab number 2. That's it. Simple and straight indeed. So I don't think so there is any complication in this case. We just need to remember gain loss is to be taken in the P&L if it is FPTPL, OCI if it is OCI, and in OCI the only other thing is accumulated balance. Brilliant indeed. So let me just bring you to the case number 2, which is given in the study material. Yes, this is the interesting case. Illustration number 11 is on the case number 2. Now, this question needs a little more broader understanding of the concept. You need a
सर
little more understanding. हाँ जी बेटा. Oh,
आपका वीडियो बंद हो गया है सर.
yeah.
यस
Good day,
स्टार्टेड नाउ.
the moment I start technical things, my video gives me a kick. Anyway, okay. So now, in terms of this illustration, we need to now get a little understanding of India's 28.
अरे उसकी वजह से थोड़ी ना.
Sorry. Okay.
Sorry, sir.
Now my input is, I've got two choices. Choice number 1, that I don't do this question till I'm done with India's 28. Or the second choice is I give you some inputs on India's 28 at this stage and we cover up this question at this stage. What do you want me to do? Leave this particular question till India's 28 is done? Or I give you some background of what is required on India's 28 and do this question right at this stage? Your choice.
So please give some background.
Okay, wonderful. So before we do this illustration 11, I guess I need to give you some background. So let's, I think, first create a background in your mind regarding Indus 28. We'll come to the details later when we come to 28, but to the extent we require, let's have a look. So let's consider an example. I am basically giving you an inputs on Indus 28, a basic overview. A very basic overview of the standard to the extent it is required to understand this particular aspect of 103. Now, Indus 28 triggers when you get a significant influence over a company. Now, when do you get a significant influence? Generally, in terms of percentage, when you get 20 or more than 20% stake in the company. So let's take an example to understand this. Let's consider that there is a company A Limited and it acquired, let's say, a 25% stake in B Limited. So you can say that he gets a significant influence over B and B becomes an associate and A will be required to account for the investment under 28 using equity method. Now, let's assume that he acquired the investment, let's say, to the extent of, let's consider 28 lakhs. So let's say he acquired the investment at 28 lakhs. Now, let's say on the date of acquisition itself, on the date of acquisition, let us say the net assets of B Limited. Let's say the net assets of B Limited is to the extent of, let's say, 100 lakhs at a fair value. So let's say the date of acquisition, the net assets of B Limited is, let's say, 100 lakhs at a fair value. Now, when A gets a 25% stake in B, he will get a 25% share in the net assets as well. So in this particular case, we can say that if he gets a 25% stake in the company, he gets a 25% stake. So he gets 25 lakh share in net assets. So he will say that out of the total net assets of the company, I get a 25% stake, that is 25 lakh. Now, what would he say at that date? I paid 28 lakhs and I got a share in the net asset 25 lakh. I paid a premium of 3 lakhs, which can be called as a goodwill. So what he will do, he will calculate a goodwill at this stage. He will say, I paid 28 lakhs to get this stake. In return, I get 25 lakh in the net assets. So I will get 3 lakh rupees of goodwill. This is what he will do on the acquisition date. Simple and straight. Now let's say if I tell A Limited to make a balance sheet on this date, a consolidated balance sheet. Because when A gets a significant influence over the company, he is required to make a consolidated balance sheet. So if I ask A Limited to make a consolidated balance sheet on the date of acquisition. So let's say A Limited makes a consolidated balance sheet on the date of acquisition. He will represent this investment at 28 lakhs and reflecting in the inner column that there is a goodwill of 3 lakh. That's it. So what he's going to do in this particular case, he will show this investment as one line. He will show this investment as a one-line figure. He will say that the investment I acquired is at a cost of 28 lakh, and he will show that the excess premium paid goodwill as a part of the carrying value of the investment. So can I make a statement at this stage that the investment is appearing in the balance sheet at net assets plus the goodwill? Or rather, I would say it is appearing at the share in the net assets plus goodwill. Did you get the understanding so far? Then I'll take it further. Great. Which means that under the equity method, your investment appears in the balance sheet at the share in the net assets plus a goodwill. Now, the standard setters understood something interesting. They said that if you want to account for this investment post-acquisition, if you want to account for this investment in a post-acquisition as well, the game is going to be very simple. You know what we're going to do is a very interesting input. Let's say this is A Limited, the investor, and let's say this is B Limited, the investee or the associate. So what you're going to do in a post-acquisition is a very simple affair. If the net assets of B Limited goes up, your investment goes up. If the net asset goes down, the investment goes down. So we are going to basically track the changes in the net assets. In the post-acquisition, what we're going to do, in the post-acquisition, we will basically track the changes in the net assets. And the simple concept which will apply is that if the net assets of the associate goes up, the investment is to be increased. If the net asset goes down, the investments is to be decreased. So there is going to be, you can say, a mirror accounting. There is going to be a mirror accounting. So what I'll do, I will look at the changes in the net assets of the associate. If the net asset goes up, I will increase the investment 25% of the change. If the net asset goes down, I will bring down the investment 25% of the change. So I will basically capture the increase decrease as a part of the investment to the extent of my share, to the extent of 25% in my example. So I will keep looking at a track that if the net assets of the associate company goes up, I'll say investment debit, 25% of the increase. If the net asset goes down, I'll say investment credit, 25% of the decrease. But the other important question is that if you will debit investment because net assets went up, or if you go to credit investments because the net investments, net assets went down, what is the corresponding entry going to be? I think let's consider an example. Whatever he credits, he will credit the same thing. Whatever he debits, he will debit the same thing. So if he says, I credit P&L, he will also credit P&L. If he says, I credit OCI, he will also credit OCI. I think let's take one or two examples to get it more clear, because this will help us to apply this example. I'll give you an input. You just give me an answer on two situations. Let's say this is the company investor A and this is the investee associate B. He earned a profit in the P&L section. He earned a profit in the P&L section. Net assets went up. Can you tell me he will put the entry investment debit credit what? He earns a profit in the P&L section. Net assets goes up. So he'll put an entry investment debit and credit what?
P&L.
Wonderful indeed. Let's give you another transaction. Can I say he revalues the asset on the upward revaluation? So he credits what? OCI. Index 16. Now what is the entry he's going to pass? Investment debit credit what?
OCI.
Wonderful. So now you can see that the post-acquisition accounting, can I say, will lead to a credit in the P&L or will lead to a credit in OCI. I hope I made my point clear. The post-acquisition changes which you are going to track will lead to a credit in the P&L or will lead to a credit in OCI. Which means the application of equity method will also lead to accumulated balances in the tab number 3. Am I right?
Yes, sir.
That's wonderful indeed. So this is what I'm going to use now in the standard. So if there is an accumulated balance in OCI in tab number 3, what do you do with that accumulated balances when you switch over from a significant influence to a control?
Shift to
I
tab.
will have to basically, yes, not exactly in tab 2. I'll have to see whether the amount in tab 3 is OCI R or is it OCI NR. I hope you got my point. If it
Yes,
is
sir.
OCI R, where will it go?
OCI R, then it will go to P&L.
Wonderful. And if it is OCI NR, where will
Then
it go?
tab to return earning.
Superb. Which means the moral of the story, if I want to now add up like this, let's give you a complete chain of thought in this case. This is one area where question has been asked in the exams as well. And I'm going to do a practical question with you, but let's get the chain very clear now. So I am now working on the step acquisition, a little more detail on the step acquisition where it is a conversion from a significant influence to a case of control. So there are two things which I now need to do. There are two things which I need to do. Number one, I would say the first thing I need to do is I need to compare the book value. I need to compare the book value versus fair value on, you can say, on step acquisition. So I will compare the book value versus fair value on the step acquisition. And in this particular case, if there is a gain or if there is a loss, that gain or loss will be taken in the profit and loss for sure. But there is another thing which I said I'll talk later, and that's the other thing. What is the other thing I need to see? I need to see because of applying. So we need to see that because of applying the equity method, we need to see that because of applying equity method as per Index 28. I need to see that because of applying the equity method as per Index 28, there will be an accumulated balance. There will be an accumulated balance in tab 3 of SOKI. So because of the application of this particular method, there will be an accumulated balances in tab 3. So what we're going to do in terms of this accumulated balance, we will do a scrutiny. We will do a scrutiny and identify which balance is R and which balance is NR. Remember, in case of passive investment, the accumulated balance was OCI NR. Therefore, scrutiny was not required and that was taken to tab 2 directly. But in this particular case, the accumulated balances will be a combination of R plus NR. So the money which is supposed to be R will be transferred to profit and loss account, recycled. And the money which is in terms of NR will be transferred to retained earnings, that is shifted to tab number 2 from tab number 3. I hope you got the picture very, very clear. So these are the two agendas which I need to take care. So my mind is now working on a PHI, that what am I supposed to do? My mind is now working that on the date of acquisition, you need to revalue the investments. If it is passive, to control the gain loss in the P&L or OCI as the case may be, and accumulated OCI transferred to retained earnings. Second, if it is a case of significant influence to a control, the gain loss on revaluation is taken to the P&L and the accumulated OCI is scrutinized. See what the balance in the OCI is R and R. R balance is taken to the P&L and NR balance is going to be taken in terms of retained earnings. Let's now have a look. So there is a wonderful illustration in the study material, and I'm going to take you to that wonderful illustration number 11. So we're going to read this illustration. It's a beautiful illustration which involves a combo of Ind AS 28, what is done in terms of step acquisition 103. It says on 1st April X1, PQR acquired a 30% voting share, which means it has got a significant influence, which means it must have accounted under equity method under Ind AS 28. So PQR acquires voting 30% shares for 8,000 crores. That is the original cost. PQR accounts for the investment using equity method as prescribed under Ind AS 28. Then he says the status at the end of the year on 31st March X2, PQR recognized the share in the net asset changes using equity method of accounting. So he's already said that over a period of 1 year, what did he do? What I taught you earlier, he saw the changes in the net assets of the investee and accounted for the changes to the extent of a share. So he took the share in the profit and loss. He took the share of the exchange difference in OCI. He took the share of the revaluation surplus. Now your mind needs to be very clear that what is taken in the OCI, was it R or was it NR? So if I see the share of exchange difference in OCI arises on account of Ind AS 21, and that is recycling in nature. So this amount is now going to be transferred in the P&L. Then the revaluation surplus in PPE arises on account of Ind AS 16, and that amount is NR in nature. And this amount is going to be shifted in retained earning. So due to the course of equity method application, when he booked an exchange gain, he took it in OCI. So he did the entry investment debit to OCI credit with the share. When he did a revaluation of the asset, he said revaluation surplus OCI gets a credit. So what he would do, investment debit and OCI gets a credit, which is NR. So due to the foreign exchange difference, OCI got credited. Due to the revaluation surplus, OCI got credited, and the amount is RNR. So this is what we have done, scrutiny. What is taken in the P&L, of course, I'm not concerned. I'm only concerned with the amount which is taken in the accumulated in OCI. Let's read further. The carrying amount of this investment in the associate on the balance sheet date is therefore this much. So what he did, he took that 8,000 cost, and to this cost he added the post-acquisition changes. To this he added the post-acquisition changes, and the post-acquisition changes is 850. So when you add 850, it works out at 8850. So 8,000 plus the changes in the net asset, the value is captured. So right now the investment in the books is standing at 8850 as per the equity method. Okay, then let's have a look further. Let's have a look further. I guess I'll just put the answer there. I'll put my own entry as well. Then he says on 1st April X2, PQ acquired the remaining 70% for a cash of 25,000 crores. So we are given the fair value of that 30% already owned, that is PHI. And then he says the fair value of the net assets is 30. How would you do the accounting for this business combination? So my advice would be, though you can see that there is a single entry given out here, but my advice would be that, you do separate entry, do 3 entry. When it is a case of a significant influence to a case of a control, my advice is go stage by stage. Let's pass 3 entries on date of acquisition. Let's put 3 separate entries on the date of acquisition. Number 1, you need to compare the book value versus the fair value of the PHI and put that money in the P&L. So what is the book value of the investment? The book value of the investment is 8850. And what is the fair value of this PHI? It is given to me 9,000. So first you just compare the book value and the fair value of PHI. So take care of the PHI to begin with. So in this particular case, there is a gain to the extent of 50. So put an entry, revalue the investment, put the entry, investment gets a debit and the P&L gets a credit. This is to the extent of 50. Go step by step, don't hurry on these things.
Sir,
So I will, yes. So in this particular case, I will compare the book value versus the fair value of the PHI, and whatever is the gain or loss that would be captured in the P&L. That's one. Second, what I need to do second is I would suggest that you need to do a scrutiny. You need to do a scrutiny of OCI, whatever is the scrutiny of the accumulated balance in SOKI. So you need to now do a scrutiny of the accumulated balance in SOKI and identify what is the R and NR portion. And we've already seen that 100 is the R portion and 50 is the NR portion. So 100 is the R portion. So what I'll do, the other comprehensive income gets a debit and the portion which is R is taken to the P&L, which is 100. And this is for the portion which is supposed to be recycling, and the portion which is no recycling, you can take OCI gets a debit and the retained earning gets a credit, and that is to the extent of 50. Do separate entries for that. So that you keep a very good track of what is happening. Take an entry for the fair value versus book value gain loss in the P&L. Scrutinize the accumulated balance in SOKI, see what is R and R, and then you can come to the entry which is pertaining to acquisition accounting. So let's give you the acquisition accounting as well. So the third is we're going to see the acquisition accounting. So let's see what is the acquisition accounting in this case. The acquisition accounting is simple. The net asset gets a debit. The net assets is to the extent of 30,000. And let me see the purchase consideration. Now, the purchase consideration is what you paid now plus the PHI at the fair value. So we've got a purchase which is now and the PHI. So what is the amount of PHI? It's 9,000, and what did you pay now is supposed to be a total of 25. So this becomes 34,000. The PC becomes 34. What you paid today is 25,000. What is the PHI at a fair value is 9. And now what we need to consider in this particular case, the balancing figure in this case is goodwill, and that is to the extent of 4,000. Now, if you want to have a look at this consolidated entry, you can see the consolidated entry. I have split the entries into 3 different parts. Now see the entry. You can see the net assets is 30 in my entry. The goodwill is 4 in my entry. This is the foreign currency FCTR, foreign currency translation reserve, which I have captured out here. So this is FCTR, the OCI debit. This is to the extent of 100. And this is the revaluation surplus. Tab 3, this is called a revaluation surplus. The Index 21 figure is going to be called as foreign currency translation reserve in tab 3. The revaluation surplus is going to be called as revaluation surplus in tab 3. The consideration of 25,000 and the investment 8850 and the gain on the previously held investment. Now, if you see this 250, what is this 250? This 250 is nothing, but it's a sum total of this 100 plus 50 plus another 50. No. This is 250 is the gain on the PHI. I guess this is coming to 150 plus 200 something. Okay, let me just reconcile. The retained earnings 50, that's taken, correct. And then there is the gain on the previously held investment is appearing at 250. I guess 250 is not the gain on the PHI. The gain is to the extent of, oh, my mistake.
Sir, I was
This is,
talking that first.
oh, 150, right? My mistake.
150.
Yes. So now if you take the sum total, it's 250. So 150 plus 100, that makes it 250. Great. So basically my suggestion is either you put a consolidated single entry or do 3 entries. So, if you do 3 entries, you keep a good track in terms of what is happening. You know that you've taken the comparison of the fair value, you've done a scrutiny of the OCI, and you're doing a separate acquisition entry as well. So let me now map this up. This was my special issue, PHI. At this stage, I need to make a little small mind map, just like the 3 concepts. I gave you a mind map on the DC, CCE, CCS, TC. I don't think so we need a mind map. I am now going to give you on the PHI. So let's see a small little mind map on PHI. So every component is got some agendas, what you need to be very careful on. So let's make a small little chart now. So I'm going to give you the entries which you are going to pass under different permutations, combinations. So I'm looking at a situation and I'm looking at the accounting entries. I'm looking at the accounting entries. So the situation number 1 is a conversion from passive to a situation of control. And I'm looking at a case where there is a conversion, signaling influence to a control. So when you make this mind map, back later, you can also map up the illustration number. So you get your good registers ready where you got the concept with the illustrations mapped up for later revisions in life. Helps a lot. Okay, now let's have a look in terms of this case. Passive to control, there are 2 situations. It was the earlier accounting, which will be given in the question. If let's say the earlier accounting was FVTPL or the earlier accounting was FPTOCI NR. Now let's see the walkthrough. So what am I supposed to do? I am supposed to revalue the investment. Yes. And the gain or loss will be taken where? Will be taken in the P&L. And then is there any scrutiny? Is there any accumulated OCI balance? Not applicable. So nothing to be done. And then if it is FPT OCI, do we revalue the investments? Yes. The gain or loss is taken in the OCI. And is there any accumulated balance in the OCI? Yes. And this will be transferred to retained earnings directly. No scrutiny required because it is NR. Therefore, no scrutiny. Let's go to the next one now. So let's see, significant influence to control. So the earlier accounting was equity method. So the earlier accounting in this case was equity method. Is there a revaluation required? Yes. And the gain or loss is going to be taken. The gain or loss is going to be taken in terms of P&L. Is there accumulated balances? Yes. So what we are required to do? Scrutiny. And depending it is NR or depending it is R. If it is NR, put it in RE. If it is R, put it in the P&L. So this will give you a bird's eye view in terms of what is to be done at each stage. And of course, after this, your acquisition entries will be done. So this is what you need to do in terms of two factors. So keep the two factors very clear in mind. Keep the factor that there is a need to revalue the investments. Gain loss is to be captured in the P&L, OCI, whatever. And is there any accumulated OCI balances? And is it to be put in the RE or any scrutiny required and taken in the P&L or the RE? I hope, friends, I got the picture very, very clear. Right? So far, so good. Let's now come back. We are still back on our original chart of the 7 issues which we were discussing. So I am back to the agenda as far as my original chart is concerned. So now I think we have covered DC, CC, PHI is and this. Now we are now going to go to the next one. The PHI is done. We're now going to go to the share-based payment. So let's have a little discussions now on the concept of a share-based payments. Wow. That is another area where you can get independent questions in the exam. So let's go to the SBP now. So here I need to give you some very interesting inputs based on this. So let's, I think, give you some inputs based on the next issue of discussion, that is SBP, that is called share-based payments. You know, when we're going to do a larger question with you, you will certainly see that all these inputs are going to be very, very helpful indeed. Tomorrow, I will be doing some larger questions with you because we are almost done with our steps. So I'll be picking a larger question with you where you're going to see the complexities in terms of the 7 steps. Then after that, we'll come to the concept of reverse acquisitions and common controls as well. Okay, so let's begin the journey. I am now considering share-based payments. Now, watch the situation carefully because I need to first of all convince you in terms of why are we looking at a share-based payments as a part of the consideration. So let's first visualize something out here. Let's say there is a company A Limited and let's say there is a company B Limited and this is acquirer, accounting acquirer, and let's say this is accounting acquiree. And let's say this is the employees. Let's say this is the employees of B Limited. So I'm taking a position where A is the acquirer, B is the acquiree, and I am given that B has got certain employees as well. Now please look at this carefully because you need to be first get convinced on the fact why are we talking of share-based payments. I guess you have a little idea about accounting for SBP, right? Can I just safely assume you know the accounting for equity settlements? Can I assume that? I don't need to give you inputs on that?
Yes, sir.
Great. Wonderful. Now, B Limited gave certain equity settled awards. Let's say B Limited gave certain equity settled awards to its employee. Can you tell me what would be there in the books of B? What balances must have got accumulated in the books of B? If he's accounting for this equity settled awards, what is the balance accumulated in his books?
Share-based payments outstanding.
Yes, SBP reserve, which would be a part of the other equity, correct? So there would be an SBP reserve balance in the books of B, and this SBP reserve would be a part of the other equity in the balance sheet of B. Now comes A. Now what's this transaction? Let's say A acquires a control over B. Let's say B has got a number of shares to the extent of, let's say, 1,000. And let's say A Limited acquired a total of 600 shares in B. So that means he got a 60% control over this company. Now, B has issued ESOPs to the employees, and these ESOPs will be called as what? Potential ordinary shares, correct? So they will be called as potential ordinary shares because they will be converted into ordinary shares in the future date. So let's say B Limited promised to the employees that I will give you, let's say, a total of, let's consider 400 shares. So he said that I'll give you a total of 400 shares. Now there is a big problem. And the big problem is when B will issue 400 shares to the employees on ESOP conversion, his share capital will become 1400 instead of 1000. So if his capital becomes 1400 and A has got a total of 600 shares, at that stage, upon the allotment of shares, will his percentage dilute? Yes. He will be left with a total of 43% shares approximately. That means he will lose the control at that particular stage. Do you think A Limited will be quite aware of this fact at the date of acquisition? Yes or no? So when he is acquiring the shares in terms of B, would he be quite aware of this fact that B has got certain potential shares? And once they convert into ordinary share, is A would be aware that he's going to lose a control on that date? Yes, that's
Yes.
correct. So if A is quite aware of the fact that on the issue of these shares, A will lose a control, he will get worried at this stage. So what he will do? He will approach the employees of B on the date of acquisition. So he will approach the employees of B Limited on the date of acquisition and he will tell them that I am ready to replace your share-based payments. He will say, I am ready to replace your share-based payment awards, we can call it as. So he will say, let's do one thing. I will give you new ESOPs in place of these old ESOP. You forget about the ESOPs which B is given to you, but I will give you these ESOPs. Now the problem is, why would the employees of B, feel that, okay, let's take these awards from A. So A would try to, incentivize them. Maybe employees of B are already convinced in life that A is a bigger company than B and they may easily agree to a switchover. Or maybe the employees of B are not very convinced with the fact and they do not agree to the deal of A. So A will try to incentivize them by making changes in the remainder vesting period. Like for example, if the vesting period was, let's say, a total of 5 years. And let's say out of this 3 years have already passed by. The employees are required to fulfill another 2 years to get entitled to the shares. So A might tell them that, okay, I reduce your vesting period from 5 to 4 years. If you're willing, you can take the shares. That means A may try to change the vesting period, reduce the vesting period to induce the employees to agree to the switchover. Or maybe the employees of B are as it is willing and they want to go for a switchover. So this is the background on the basis of which A will offer the share-based payment to the employees of B. But what is the larger picture? Why am I talking of this in terms of a purchase consideration? I'll now tell you that why I'm talking of this. Now, let's get the picture further clear. So if you look at A Limited and if you look at B Limited, so let's see now the accounting in terms of this. B already has an SBP reserve in his books of accounts. And this SBP reserve is supposed to be other equity. It is not supposed to be a liability. The books of B is containing an SBP reserve, which is other equity and not supposed to be asset liability. So when A does an acquisition entry, can I say this SBP reserve will not be taken over? He's going to record the assets and liability, but he's not going to record this SBP reserve. But if A is replacing the awards to the employees of B, he's responsible in terms of creating this SBP reserve the way B created in the books. Now there are two alternative entries. Watch this carefully. I'm giving you two alternative entries in terms of incorporating this SBP reserve. I'm giving you two alternative techniques in terms of creating this SBP reserve. So get the picture clear. So what we're looking at is that B in his books of accounts has created an SBP reserve, which is other equity. So A cannot take over this as a liability. So A doesn't incorporate this SBP reserve. But since he is going to replace the rewards, then in that case, A is responsible to create an SBP reserve. So there are two ways in which an SBP reserve can be created. Now, alternative one. Let's see what is the alternative one. When you put the entry that is assets gets a debit and liability gets a credit. Now what you can do at this stage, when you go to the step number 3, remember step 3, list of net assets. When you go to the step number 3, as a part of the list of net assets, you can calculate the amount of SBP reserve to be created. That's what I said in step number 3. If you remember in step number 3B, to be precise, I gave you in step 3B, we said we'll discuss this later. So when you make the list of the net assets, then as a part of the list of net assets, you create a SBP reserve as a part of that list so that automatically it gets incorporated in this entry as a liability, Alternatively, what I can do, when you put the entry assets debit and liabilities credit, don't take it as a part of the liability. What you can do, when you consider the purchase consideration, in step number 4, you can include it in PC. You can include it in the purchase consideration at this stage. Now you'll say, so that's funny. That's really funny. Why are you including it in the purchase consideration? The idea is to include it on the credit side. Let's get it mathematically clear. The idea is to include it on the credit side. You put it as a part of the liability, you put it as a part of the PC, it gets included on the credit side. But if you do this, then I am required to pass another entry as well. I can put the entry PC debit SBP reserve gets a credit, and this can be done as another entry later. Did you get the crux of the two alternatives? Either take it as a part of the liability and get the SBP reserve created in step 3B, or you take it as a part of the PC and get it created on the credit side, then put another entry, PC debit SBP reserve credit. So either you create the SBP reserve directly or you create the SBP reserve indirectly. You are free to do any alternatives you want. You want to take it as a part of the list, step 3, you can. You want to take it as a part of the PC, you can. I have seen questions in the education material and in the study material, and generally the alternative number 2 is being applied. And I think it's easy to keep a track as well, because you'll never miss out on this particular information. So what is generally being done is a preference is being given to the alternative number 2. So when you do the alternative number 2, in this case, when you record the assets and liability, miss out the SBP reserve, but just add it in the purchase consideration. And then put a separate entry, PC debit SBP reserve credit. Did you get my points? I hope, friends, I'm clear with the picture. So let me just, quickly consolidate the inputs further to you. So what I'm looking at is the 6th issue in terms of purchase considerations. We've done DC, CCE, CCS, and TC. We've done PHI. Now we are on SBP. Can you imagine? We've still got a 7th issue, and I told you that one full class will be devoted to the concept of purchase consideration only. And pre-existing relationship is again not a small area. That's got another few complications, which we will not discuss today. We'll be discussing that tomorrow as well. One entire class gets spent on the calculation of the purchase consideration. Okay, so let's now, first, get the view. Then we'll start working in terms of what is the amount to be recorded out here. So the map plan is A as an acquirer is definitely, in most of the cases, approach the employees of B. Why? Because if the employees of B are given ordinary shares from these ESOPs, A knows that his control may get diluted. If he knows that the control will get diluted, he may not have a problem. But if he knows that the control is lost, he may have a problem. So it's not necessary that every time he will think in terms of replacement. Because let's say if he's already acquired a 90% stake, and because of this ESOP, even if his stake comes down from 90 to let's say around 80%, he's not worried. He says that's okay. Even if my control gets diluted, he's comfortable. He will not approach the employees and not give them a replacement. But when A knows that because of this ESOP, he will lose a control, he is worried, and he would, approach the employees and tell them that I am going to give you the share-based payments. Forget about the awards given to you by B and let's replace these awards. But the challenge which comes in accounting at that stage is when A tells the employees of B that I'll give you these awards, the main agenda is that in the books of B, there is a SBP reserve. That's not a liability. That's a part of the other equity in the balance sheet of B. And as an acquisition entry, you're going to record the assets and liabilities of B, but not the other reserves. So in this particular case, when A decides to go for a replacement, he is responsible in terms of creating that SBP reserve in the books of accounts. So what is the amount of SBP reserve to be created? We will discuss that very rightly shortly. But I said there are two alternative ways of incorporating this SBP reserve in the books of accounts. So one of the techniques is that you incorporate this as a part of the step 3B list. When you put the acquisition entry, you clearly record the SBP reserve as a part of this liability. Alternative number 2, you don't take it in the net asset list, but when you take the PC, include it in the PC. But then remember to put another entry, PC debit, SBP reserve credit. That's how A would incorporate the SBP reserve. Now the question arises, what is the value? Now the question is, what is the amount of SBP reserve to be created in the books of A? That's the million-dollar question. So the next issue is, what is the value, the amount at which this SBP reserve is going to be created? Now friends, hear me carefully. I will now give you again a simple 3-step model. Oh my God, sir, how many steps do we remember in life? I'm going to give you a simple 3-step model. We'll work upon this because there is much more in terms of share-based payments on this. But I'll give you a simple 3-step model which you need to apply. Watch this. So we will apply a 3-step model to decide the amount of SBP reserve to be created in the books of the acquirer. So in step number 1, what I will do, I will organize the fair value. I will organize the fair value of the original award. I will organize the fair value of the original award. Original award means what was given by the acquiree. And I will also get the fair value of the replaced award. So we will organize the fair value of both the awards. You will see this data very clearly given in the question. So I will pick up that what is the fair value of the original award and the replaced award on date of acquisition. This will be very clearly stated in the question. You won't have to make any efforts in terms of identifying that what is the fair value on the date of acquisition. You'll see the question, the data will be clearly given. Let's assume some figures for convenience. Let's consider this is X and let's consider this is Y. Then we go to the step number 2. So we need to consider what is the amount of SBP reserve to be created. Then we go to the step number 2 to decide what is the amount of SBP reserve to be created. So we will consider the fair value of original award, which is in step number 1 on date of acquisition. So we will consider the fair value of the original award, that is X, on the date of acquisition, and we don't need to create a full fair value, because you always account for a fair value as per Ind AS 102. But what you do in terms of Ind AS 102, you spread it on a straight line basis, 1/3, then 2/3, and minus what is taken in the previous year. So the amount of SBP reserve to be created is not the entire fair value, but it depends upon the vesting period completed. It depends upon the vesting period completed, and the standard says original or total vesting period, whichever is greater. Now you would say, sir, why are you considering original or total? You should simply say that if the original period is 5 years and 3 years is done, 3/5. Remember I said in order to induce the acquiree's employee, I might have to change the vesting period, let's say from 5 to 4 years. So in my example, the total vesting period is 4 and the original vesting period is 5. If you reduce the vesting period in that particular case, I'll not give you the benefit. You will still have to consider in this case the original or total, whichever is greater. If you increase the vesting period, for example, let's say the acquirer company is a very big company and he tells the employees of the acquiree, I will increase your vesting period from 5 to 6 years, then I will take 3/6. So in the denominator, you need to consider the original period or you need to consider the total period after the revision, whichever is greater. So this proportion will be entered as a part of the PC. So this amount of SBP reserve is going to be a part of the purchase consideration in terms of the step number 4, which means when you are considering SBP reserve, I need to consider pro rata fair value. Because I will take the fair value of the awards into the period completed upon original or total. So it's a proportionate fair value which is being considered as SBP reserve. Then comes the step number 3. So this is a part of the PC. Then comes step number 3. Now there is something which is to be accounted. There is something to be accounted as post-business combination. There is something which is to be accounted as a post-business combination. At the end of the day, the fair value is Y. So what I need to do, the difference between Y minus the figure in step number 2. Because you've created an SBP reserve, the ultimate total SBP reserve to be created is the value Y. So whatever is the difference between Y and the figure in step number 2, this difference will be accounted as per Ind AS 102 later. In a post-business combination, this will be accounted under Ind AS 102. No worry, when we see a practical illustration, we'll get more clarities of thought. So don't get worried on that. So as of now, you need to be clear on the 3 steps which you need to apply. Organize the fair value of the original and the replace awards on the date of acquisition. You need to basically account for the entire Y. So what we're going to do as a part of the business combination deal, we will take the fair value of the original award, that is X, take a proportion of that X based on the vesting period completed upon original or total. Now, Y is the total accounting to be done. Out of this Y, a proportion of X is being taken in the books. So the remaining Y minus the value as per step 2 will be accounted subsequently as per Ind AS 102, subsequent to post-business combination. Right, friends, I hope I am clear with the conceptual bit. We will be doing questions also on this area. I have another cases. This is not the end in terms of share-based payments, because there are more combinations in terms of SBP which we need to discuss. We'll discuss more of these things tomorrow, and we'll also discuss the pre-existing relationship. Then we've got more inputs in terms of step 5 and 6, which is not very hard. Goodwill and NCI, and I'm going to do some comprehensive questions tomorrow. So please do revise all what we have done, because tomorrow, once we do a comprehensive question with you, you need to be very clear on all the individual inputs we've learned on these steps. Right, friends, over to you for any questions on your side.
Yes, sir.
Okay, wonderful indeed. That's wonderful. Right, friends, so I think then it's time to bid you goodbye. So we're going to see you tomorrow back at the same time to continue with this interesting discussion. Thank you very much. Enjoy your day. Bye-bye and take care. Thank you. Haji, thank you.